Morning, friends. Coach Ernie here, and this is the 0DTE morning market analysis, and volatility is back! Sorry for getting so excited, but when I see volatility, that's all I can think of. It looks like we had a kind of a reprieve. We had this massive drop in volatility after the last couple of weeks, dropping from 29 all the way down to just 17, which is just above zombie land. And it's as if the market got a whiff of zombie land and said, we're going the other way. Well, this morning we're going to, and there's a number of reasons for that. We'll get into that in a little bit of detail. But this morning there is heightened anxiety over the PCE, which is an inflation metric that's going to be released at 8:30 this morning. And it's provided a reprise of the big ass fly. We briefly went up into the 20s for the debit on the big ass fly. Now it's back down. That's all good stuff. It's going to mean we're going to go wider flies. Instead of me just talking about it, let's get to the charts. Whoop, bad timing. Okay, do that again. Get to the charts. That's not a chart. Well, anyways, I'll give that another shot here. There we go. All right. So we always start out with the VIX. It's our playbook. Our entire strategy is driven by volatility. Of course, we're going after three primary edges: the change in time, change in price, change in volatility. But the VIX sets us up for determining what trade, what's the condition of that trade, what are the criteria, where's the, and then of course there's volume profile that gives us our entry event and structure that will determine where that entry event is likely to occur. So the first thing we need to do is look at the VIX. And as you can see, the VIX has basically done an about face as soon as it hit that 17 level, which is where I demarcate between the Goldilocks zone and zombie land. Those are my names for these varying volatility regimes. And it seems like the market is paying attention to me today, I guess. But anyways, the VIX is now up around 19, where just 2 days ago, it was down around 17. That's a significant advance, by the way, and enough to create a lot of stir in the market. Of course, there are renewed issues where people are talking about tariffs. As I said earlier in this month, I said that tariffs are going to be a major issue going all the way through 2025. There's going to be what I call whisper volatility, whisper attacks on tariffs. And every time there's a new news or a new threat to the globalists, they're going to go nuts, and then that's going to cause the markets to go haywire. And of course, we love that. So anyways, this means that we're again back to 25 to 35 wide. We need to go to the big ass fly and see where that is so we can see what end of that range that we should be looking at. And so to do that, we need to go to our Thinkorswim and look at the big ass fly, which is a 50 wide at the money. Can't talk this morning. At the money butterfly trade. And what we're looking for pre-market is what's the debit on that trade. Because the lower the debit, that means the higher the implied volatility for that day. And it gives you a very strong clue on how the market is pricing options. And again, that's how we are essentially driven in our strategy. And we can see now it's at 16.45. That's pretty low. And we'll go back to the VIX in a second. But this also means that we're setting up very nicely for a big-ass fly early morning trade where we're looking for, after the PCE is released at 8:30, we're looking for a volatility crush event. And so what will happen is if we're in the market at that point, when that volatility crush event happens, which always happens regardless of what the outcome of the report is, we'll almost immediately get a $1, $2, maybe even a $3 increase in the value of that fly. And that's an awesome trade. So that's what we're looking for. And so now if we just go, look, Jesus, already jumped up to 17. I don't know what's going on there, but 8:30 is still another 40 minutes away. Let's go back to our VIX playbook. And we can see where 16 or 17, it's over here somewhere. So it's definitely on the wider side in Goldilocks 1 here. You can see that's where we are. Goldilocks 1 on the VIX down here. And then up here is our width guide. And we can see we're between 30 and 35 wide. So we're definitely leaning towards wider flies this morning. All right, so next step is to look at directional bias. Even though we are a little bit down this morning, we're still above the moving average, so our directional bias is bullish. That means we're going for 30 to 35 wide call flies, out of the money call flies. And remember, when we put on a fly, we always go for asymmetric risk to reward, meaning that we're pushing that fly way out of the money so that the debit is never more than 10% of the width of the fly. So on the SPX, that would mean if it's 30 wide, then the debit would be $3 or less. All right. If you're working with the XSP, then that's 1/10 the size. That means it will be a 3 to 4 wide fly, and the debit would be 30 cents or less. All right, so there you go. And then the next step is to look at where the entry event is likely to occur. And that is all set up with our analysis of volume profile. These are all the levels that we've identified and that identify the structural levels within the volume profile. And what we're looking for is obviously, as I said, a bullish bias. We're looking for price to move up and then pull back into one of those structural levels, very similar to what happened here over yesterday. So you see it's pulls back and then moves up. That's the move that we're looking for, that move right there, right? I don't know, maybe I can put an arrow there and show you and say, okay, that's the move that we're looking for right there, where it goes, hits that structural level and then moves up. And so I've shown that with the path arrow here. And so we're looking for something very similar. We don't know which level that it's going to bounce off of, but I'd say about 85 to 90% of the time it happens every morning that it will bounce off of one of those levels. And we're just waiting for that event to happen. And we use this indicator down here as one of our primary tools. It's what we call the opening score divergence. And it is looking at multiple non-correlated indicators or aspects of the market that include price action, momentum, volatility, volume, and other linear regression and other things that are looking for divergences in the market, and then scoring them all, and then giving us a good indication where that turnabout is likely to occur. And so we have a very high degree of confidence when it hits one of those levels that it is going to reverse and then go in the direction of our bias. And the interesting thing here, let me sort of bring the big head on here and just talk about this for a bit. The interesting thing is that we might have a directional bias that's bullish. Now, does that mean the market is going to go up that day? Is that what we're really trying to do? We're trying to say that, oh yeah, we're absolutely certain that the market's going to go up that day. No, we have no idea. The fact is that even in a trending market, especially, well, any trending market, whether it's moving up or moving down, the chances or the probabilities that the market will end up in the direction of that trend is still 50-50. Sure, go back, check, look at the distribution of market moves. In a trending market, even if it's strongly trending up, the chances of it going and ending up that day is still 50-50. The reason why we go with the trend is because those moves that on average, those average moves in the direction of that trend tend to be of greater magnitude than the counter trend moves. So that actually provides us with an edge, and so that's why we trade that way. The other thing is that the market could end up down like yesterday, and we can still end up winners, right? Because the initial move was up, and we took that trade and made money. So even in a counter trend move, you can still make money. Now, again, the reason why we're going in the direction of the trend is when those larger magnitudinal moves come across, then we can make a lot more money because it will get deeper into our butterfly. You see how that works? So it's a very high probability, probabilistic trade for us to make. In fact, since we've instituted the opening score divergence and also our structural level analysis, my win rate has actually increased dramatically. And I'm not sure if it's the market or these plays, but traditionally in my trading, my win rate has been around 50%, but recently it's been up around 60, 65. Now you might think, that's a rookie win rate, huh? Really? If you look at my account, you wouldn't say that. My account has super low volatility, goes from bottom left to top right. My previous account, I had a return of over 115% with an annual compound annual growth rate of around 110%. My current account has a SAGR of about 78 to 80%. So I'm making between 80 and 110% per year on this strategy with that kind of win rate. So you can take your 90%, 95% win rate and shove it where the sun don't shine. All right. And my Sharpe ratio is the real kicker. My Sharpe ratio has consistently been above 5, sometimes as close as 6. Now, if you were to look at where that ranks among other traders, professional traders, that is institutional caliber performance. All right. Well, I mean, it's not unusual considering that I was an institutional trader and a hedge fund manager. So that's what I think I should expect. But it also represents about 0.02% of all traders. Right. That is what I'm teaching in my coaching service, how to achieve that kind of performance. And if you want part of that, go down below, click and join our school community where you'll learn all about the strategy and the process. And if you think you're ready, then sign up for our coaching service. All right, enough for the ad, but I just wanted to put all that in perspective, exactly what we're doing here. All right, so let's go back to the charts. And let's see, what did I want to look at? Okay, VIX. Is there anything else I wanted to look at? Oh, let's see. I think I have, I wanted to talk a little bit about the PCE. And let's see if we can make some sense of that. So just give me a second here. I forgot where I put my notes. So, so this morning we have the Core PCE price index at 8:30. This is an inflation-related report. It's a key for the Fed policy. As a matter of fact, they look at this very tightly, and this is one of the reasons why there's anxiety this morning and why the big-ass fly has a lower debit on it, and because there's injected volatility or injected anticipation for that report, which is coming out in just half an hour. And it's also why we are stoked and prescient on that and placing our big ass fly there, waiting for that to happen so that we can capitalize on that event. So overnight conditions, let's see what's happening. I don't see any real big things on the overnight action. I know that there has been talk about a continued talk about tariffs, as I said earlier. So I don't see a direct correlation for why volatility has risen as high as it has. Although I guess that's the thing, really. Oh, I know what one thing could be. I know that Fed President Bostic came out yesterday or the night before saying that he expects tightening in their rate policies and monetary policy, meaning that they're potentially not going to do 2 more rate hikes this year, maybe 1, maybe no more. And I think that's getting Wall Street all up in a bunch, So that could be contributing to it greatly. So that raised the temperature. And now with the PCE coming out this morning in conjunction with that disposition by Bostic, I think that's the reason why volatility is really hiking. There's also anticipation or poor reporting coming from some of the tech giants, which is also adding some pressure to all that. And so now the Fed is thinking, Okay, is all that good or bad, right? It's odd because you might have a poor outlook from these earnings reports. At the same time, the Fed is looking at the market and thinking that things are heating up. There's a lot of positive developments going on with that are associated with tariffs, as a matter of fact, and Doge and all the other things that the administration are putting together. And that is why the Fed is kind of tightening, because they would be loosening if they thought that there was a negative outlook. But they're tightening because they see a positive outlook. I don't know how much strength you put into the Fed, because their ability to predict is pretty poor. But all I really care about is that there's volatility injected into the market, and that makes us as options traders very happy. So that's everything that I've got to tell you this morning. Otherwise, I'm going to just be rambling on, which I can do incessantly. So, hey, it's been great seeing you all. Hope you all have a great weekend. And as I said, you want to be able to slay these markets, go down below and join our school community, learn all about our strategy. There will be a coach's call today within that school community at 10 a.m. And then that will be your next step of ascension to trading mastery, to becoming a professional trader. Trade like I do, all right? And join our coaching service. So that's it. Thank you very much. Coach Ernie out.